And we're going to start this show by talking about Japanese housewives. Right?
Yes, we'll talk about Japanese housewives and how they have impacted the Indian stock market. Real estate in Tokyo was so expensive that people were taking out 100-year home loans.
Of these macro events that the media plays up aren't that important, right?
We are all in the business of creating content and filling up space, right? Business news channel which starts at 7 in the morning, 3:30 the markets close and then they analyze for another 1 hour. Has to have something, right?
You just destroyed the hopes of all the retail traders up and down the country, right? Who दिन में उठ के कुछ तो करते होंगे.
All these experts come on TV and say investors should buy on dips. I think it's the stupidest thing you can say.
So Vivek, let's get into some controversy.
I would have made much more money in life if I did not understand the Indian economy. If I just understood investing, I would have made a lot more money in life.
Approach now, having burnt my fingers multiple times, is to be as hands-off as possible, to invest in broad hybrid funds or funds which have lots of freedom to move between asset classes, and leave it to the fund manager. Let them make the mistake if they have to. They probably know better than I do. What is your strategy?
I would not agree with that. Now, I don't have all my money riding on the stock market. A lot of my money is in FDs.
I agree.
Public Provident Fund, gold mutual funds. Your way is the better way.
So thank you. Hello and welcome to Moneynomics with Mint. This is Neil Borate. I'm the personal finance editor at Mint. And joining me today is the one and only Vivek Kaul, author, columnist. Vivek, you want to add more to that?
Yeah, so, Moneynomics will basically be a show where personal finance meets the Indian macroeconomy, where we'll try dealing with the larger economic issues and also talk about how that impacts, the man on the street, the aadmi, you and I. So that is the basic idea behind this show.
And we're going to start this show by talking about Japanese housewives, right?
Yes, we'll talk about Japanese housewives and how they have impacted the Indian stock market very recently and also in the years that have gone by.
Absolutely. So Vivek, run us through this sudden crash in Japan and what led to it and the 0% interest rate going away. How does this affect us?
So see, there is something known as the yen carry trade. Okay, and in order to understand the yen carry trade, it sounds like a very technical term, but it's at its heart, it's a very simple thing. There is what we call arbitrage at work. Okay, so in the late 1980s, Japan had one of the greatest bubbles of all time. Not one of the greatest bubbles of all time. It had a bubble both in the stock market and the real estate market. In fact, the real estate in Tokyo was so expensive that people were taking out 100-year home loans, which would eventually be paid by their children and grandchildren. And the other great story is that the land, surrounding the palace of the king in Japan was more expensive than all the land in the state of California.
Yeah.
Now, it's perhaps not a true story, but it's a great story. The point being that there were these big bubbles, and the Bank of Japan, which is the Japanese central bank and the Japanese equivalent of what is the RBI, the Reserve Bank of India. And so the Bank of Japan raised interest rates and burst the stock market bubble. It was, it burst the stock market bubble very, very quickly, but it couldn't burst the real estate bubble quickly, and the real estate bubble took time to burst. Yeah. And because it took time to burst, the Japanese economy suffered quite a lot because of that. So after the real estate bubble had been burst, the Japanese economy was contracting. It was what we say, what we call the gross domestic product, the GDP was contracting. So in order to sort of revive the economic growth, the central bank cut interest rates to very, very low levels. And this is where Japanese housewives came in, or what used to be called the Mrs. Watanabe trade. So some Japanese housewives figured out that it sort of made sense to borrow money in Japan at very, very low interest rates and invest it in other parts of the world where the chances of making a higher return where they had chances of making a higher return. And this is how the yen carry trade started somewhere in the mid 1990s, wherein what is the carry here? The carry is essentially the difference between the return that you make on the money that you have borrowed in yen and the interest that you pay on the borrowed money. The difference between these two is the carry.
Yep.
So this is how the yen carry trade started, and the yen carry trade has been pretty much been around since then. A lot of money in the 2000 .com or the 1990s .com bubble came into the US through the yen carry trade. Also, what happened was, once the big financial institutions saw what these housewives have been doing, I mean, they figured out that if these housewives can do it, I mean, we can do it as well. So Japanese money drove a lot of bubbles all around the world. A similar thing happened in the run-up to the 2008 real estate crash in the US and Europe, where a lot of money from Japan found its way into different parts of the world. And some of that money came to India as well, right? Now, so this is like the historical background. But how does this history impact us in 2024 is a question that we need to answer. Now, what has happened in the last few years, since like February, March 2020, when the pandemic broke out? A lot of Western economies, US, UK, and the European Union, essentially cut interest rates to very, very low levels because the economy was suffering in the aftermath of the pandemic. So they needed essentially to revive the economy. And the hope was that once they had cut interest rates, people would borrow and spend money, and that would eventually help reviving the economy. The Japanese central bank, the Bank of Japan, has also done that. Yeah. Now, in the US has essentially, it essentially cut interest rates to almost zero, and then it started raising interest rates as well. And now the interest rates in the US are at a fairly high level, whereas that is not true about Japan. In the last
4.5%, right,
yes,
in the US.
Yes. In Japan, the interest rates were still very close to 0%. So the yen carry trade started all over again, wherein institutions borrowed money from Japan and invested it in other parts of the world. Now, two things are necessary for the yen carry trade to continue to be viable. The first is that interest rates in Japan either need to be like at the similar levels or need to go down, right? And the second thing is that the yen has to either remain at the same level against the dollar, or it has to depreciate, right? So by depreciation we mean it has to lose value against the dollar.
Correct.
The moment it starts to gain value against the dollar, the yen carry trade starts gets nullified, right? So two things happened in the last 1 month. Okay, around July 10th, the yen started appreciating against the dollar, and then very recently the Bank of Japan raised interest rates because inflation in Japan is now high. I mean, it's at some 2.5-3%, but by their standards it's high. In India we would joke it off. So this essentially has led to a situation where the yen carry trade is not as lucrative as it used to be, and which is why there was a sort of a sell-off all across the world. Also, when we talk about things at such a macro level, it is not easy to attribute any rise or fall in a stock market just to one reason, because the stock market is a complex being. So experts who follow these things have said that the fall has also been because the prospect of a recession in the US has gone up, and then the chances of a new war in the Middle East have also gone up. So there are all these reasons at play, and so this is why.
So I must confess to you, about a month ago I was busy checking hotel prices in Japan and tickets, because there was a huge tourist surge when the yen was weak, and including against the rupee for once. But unfortunately I didn't grab that opportunity, and now the yen is a little back up, not fully back up, but
one of your ex-colleagues is in Japan right now. He did sort of...
Oh really? I didn't know this. Yeah. Okay. So anyway, missed chance for me. But this shock has happened with a mere 0.25% rate rise.
So which is why the markets have also not fallen much, and they have also recovered, right? So it's like, if we look, I think from last Friday to Monday, I think Thursday to Monday, the markets fell by around the Sensex, fell by around 3.8 to 4%. So it's not like a big fall. So which is why, that's the main reason, because I think the market is still not sure whether the Bank of Japan will continue raising rates. So that is what they are waiting for. Plus, the flood of retail money continues, right?
Is insatiable. Yeah, it's interesting. I mean, every time some major global event happens, our markets correct for a day or two max, and then they bounce right back. Somebody jokes it's almost like a meme stock, where nothing will drive down this market. But I wonder, in the larger context of things, a lot of these macro events that the media plays up aren't that important, right? I mean, there are some that are pivotal to our lives, and we'll talk about that in a minute. But if you think of every 2 weeks, there's something.
So that is noise. I mean, you have to see, it's like, we are all in the business of creating content and filling up space, right?
Yeah.
So a TV channel, a business news channel, which starts at 7 in the morning and goes on till 3:30, 4:30, when 3:30 the markets close, and then they analyze for another 1 hour, has to have something, right? So it's like, many years back, I read this book by a guy called Andy Kessler, who, I forget the name of the book, but he used to work for Morgan Stanley. And he made a very interesting point. He says markets are open for around 250 days in a year. Okay, so if you leave out the weekends and another, I guess, 10, 15 days, and financial results are declared 4 times in a year. Okay, so that leaves you with 246 days. So what do you do for those remaining 246 days? So you have to constantly keep, talking about something. Also, if you watch these business channels,
you just destroyed the hopes of all the retail traders up and down the country, right? Who, दिन में उठ के कुछ तो करते होंगे.
So which is why, so it's not like you cannot play on the noise, right? But then, how many people actually make money by playing on the noise? We all know the data that SEBI recently put out,
9 out of 10 don't.
Right, in financial derivatives, and whereas in intraday cash trading, where you buy and sell a stock, if you buy a stock and then 7 out of 71% lose money. And this is before we take transaction costs into account. The STT, securities transaction tax that you pay the government, the brokerage, the transaction fee that goes to the exchange. And so, everyone loves a dumb retail investor, because, people think that they will make money, but most of them don't. And it's the system which ends up making money in the process. So,
Vivek, if you can think of macro events in your life that you've capitalized on or you've missed, but in hindsight you have. So I'll recount the two in my investing life. One would be 2013, when there was taper tantrum and India had corrected. India went down to, I think, 5,000 odd levels. And after that, the rebound the next decade has been brilliant.
Actually, it's not the next decade. If you look at, mutual fund performance up until 2019, it wasn't really too good. The rebound is post the pandemic. So if you had invested from 2014 and 19, between 2014 and 19, and if you had if you were strong enough to hold on post that, then
you would have done well. Yeah. So I was just coming to the second one, which was COVID.
Right.
And again, anyone who put in money during COVID would have done extremely well. I mean, the market has gone up 3 times in the next 4 years. Now, one can counter that by saying that a lot of people, and that includes me, we were already invested in the market. Like, there was no more money to put in. But one mistake that I did in the post-COVID recovery is I got pessimistic really early. I saw all of this bad news about the economy, yet I saw the market going up, and I thought this can't be right. So I pulled out some money, and then the market kept going up.
I think, Neil, you are sort of being unfair to yourself, because, decisions are made at a point of time on the basis of the information you have. Okay, and no one can really look into the future clearly. Okay, so I can tell you my experience that, I am a freelance writer, and when the pandemic happened, I was suddenly, for almost 2.5-3 months, there was very little work. And I had a huge amount of money riding on the market. So at that point of time, I gradually started withdrawing that money. Now, in hindsight, it looks like a stupid decision. But at that point of time, I thought it was a good decision because, I didn't know that, I didn't know that the markets will rally like they did. And the factors behind the market rallying are also quite complicated. It's not like, people would have invested and made money, but if you look at it in the Indian context, one was the fact that while the overall economy was not doing well, a lot of the listed companies were having the times of their life, and the reasons were multiple. First was the increasing formalization of the economy. The smaller guys were sort of, because of the pandemic, they were falling by. Then the RBI cutting interest rates to very, very low levels, which helped the interest bills of all the companies which had borrowed tons of money come down. Then the corporate income tax rate being cut and all that. So, plus a flood of money printing that happened. Nobody had sort of thought that this kind of money will be printed. So, see, I saw money being printed in 2008 when Federal Reserve printed a huge amount of money. But the kind of money that was printed during COVID, where the balance sheet of the Fed went from some $4.5 trillion to $9 trillion. So $4.5 trillion of money was printed just by the Federal Reserve of the United States. Yeah. Then there was Bank of Japan, Bank of England. So the point is that, in hindsight, it looks like
it looks
stupid.
Easy, but it wasn't.
But at that point of time when I had no work and or I had very little work, it seemed like the right thing to do.
Yeah.
So it's not, it's very easy, when all these experts come on TV and say investors should buy on dips. I think it's the stupidest thing you can say, primarily because nobody explains as to how much should be bought and at what dip.
How big a dip?
How big a dip, right? So should you invest all your money in the bank at a 2% fall, at a 5% fall, at a 10% fall, or should you keep buying? So if you should keep buying, then you're anyway, if someone is SIPing, they are anyway doing that, right? Yeah. So, and then, when a situation arises, when stock markets crash, it's not like the jobs of people are safe. A lot of jobs are also on the line.
So Vivek, let's get into some controversy. When demonetization happened, you were one of the biggest critics of it. Now, your opponents would argue that if you think about it in hindsight, if you had been an investor at that point, you've made tons of money. Was it such a big deal?
It may not have been a big deal. See, here's the problem. The problem with a lot of people in Mumbai who make money, or as I call them, who make money out of managing or at least pretending to manage other people's money, or OPM, they can't look beyond the impact of the economy on the stock market. Okay, so it may have helped the stock market because formalization happened. A lot of small businesses which essentially worked largely on cash were destroyed, but it did hurt the Indian economy on the whole, and something and from which we are still to recover. If you look at a lot of data points, they do suggest that. So yes, it may have worked for the stock market, but that does not mean that what is good for the stock market is also good for the economy. So this is a distinction that needs to be made. So essentially, you need to have the ability to hold two opposite thoughts in your mind and retain the ability to function, which I have a difficulty with. I would have made much more money in life if I did not understand the Indian economy. If I just understood investing, I would have made a lot more money in life. But because I understand the economy also, so it becomes very difficult for me to function.
Double think, 1984. Yes. Okay. So finally, Vivek, let's talk about how we both approach macro events now in our investing lives. I'll talk about mine. So my approach now, having burnt my fingers multiple times, is to be as hands-off as possible, to invest in broad hybrid funds or funds which have lots of freedom to move between asset classes, and leave it to the fund manager. Let them make the mistake if they have to. They probably know better than I do. What is your strategy?
I would not agree with that. Some fund managers might know more, but most of them are really not. I mean, see, if you look at the performance of most Indian equity mutual funds, they fail to beat their benchmarks. So if as an investor,
I'm just contrasting against my own terrible record. So I'm like,
So I mean, I'm sure your record, Neil, is much better than most people. So it might be terrible in hindsight, but see what I have also made multiple mistakes. So one mistake that I made in 2008 was to bet a lot of money on a single fund manager who, let's not get into what happened there, but I did burn my fingers there and I lost some money. So that was a big lesson for me, wherein, you should not fall for the stories that appear in the media about a particular fund manager. Okay, I mean, unless he's Warren Buffett. So what I have done since then is as to, invest in a broad bouquet of funds and index funds, ETFs. So I also like to, diversify even within index funds and ETFs. So because what happens is with ETFs, at least in India, the liquidity can become a problem. So you can't have all your money in a single ETF. Also, ETFs which do not invest in large cap stocks in India have very terrible liquidity. So you're better off doing index fund. Then there is, as of now, I'm invested largely in a couple of large cap funds, one multi-cap fund, and there's one dynamic asset allocation fund. And some of my money is riding on banking stocks, which I thought were undervalued. And so that's about it. I have stopped my investment in SIP that I had on a small cap fund. That has been stopped. So that is how, as you rightly said, it's best to sort of be hands off. But the problem again with me is because I understand the economy, it's very difficult to sort of remain hands off. So that is by far the best way to operate, as long as you're adequately diversified. You do not have all your, right now I don't have all my money riding on the stock market. A lot of my money is in FDs.
I agree.
Public Provident Fund, gold mutual funds. I mean, I don't own any real estate, but beyond that, I think I'm adequately diversified. So if the market continues to go up, I will continue to look stupid. But to me, as a freelance, writer, what is most important is return of capital. Return on capital is the second most important thing. So that is I am quite conservative, and that is how I approach. So.
So I'm actually quite similar. The only difference is that instead of picking mid versus small cap or a sector fund, I just pick broader based.
Actually, that makes more sense. I mean, so this is again, me being, the fact that you try to sort of implement it in your own life and make a mess of it. So at the end of the day, people in an earlier era would do debt funds, then they would do equity funds. So we used to have something called as a balance fund back then. You were just better off doing a balance fund. So there was even a couple of funds which would do equity, debt and gold. So you don't have to sort of
yourself go and pick.
But it's just that you just feel a little better doing this, and there's no logic to it.
Absolutely.
So your way is the better way.
So thank you.
So
all right, viewers, thank you so much for joining us today. Hope you learned something about Japanese housewives, how they think, and how that ultimately impacts your finances, as Vivek has explained. Thank you for listening.
Thank you.